Welcome, everyone. I'm Chris Gessel, Executive Editor of Investors Business Daily and Leaderboard. And with me tonight is my good friend and IBD National Speaker, Justin Nielsen.
Hello, everyone.
Now, tonight we're going to show you how Leaderboard can help you make more profitable trading decisions. And there's a lot to cover on that topic. And we're first going to start off with an overview of the leaders list and cut list. And then we're going to dig into the life cycle of a leader, because where a leader is in its run has a lot to do with how you handle that stock and also how much profit cushion you might have. Then we'll turn to cutting losses and how that's an essential piece of succeeding in the market. Then we're going to look at leaders near a buy point, a few stocks that are setting up. They might be right near breakout points or maybe starting to break out at this moment. And then we'll look at the current market, analyze what's happening and how growth stocks overall are acting. We'll update you with the Leaderboard Performance year to date. And, of course, we'll be taking questions throughout the webinar and at the end. So, Justin, we've got a lot of new people to Leaderboard with us tonight. And why don't you take us through a couple of the key features?
Yeah, so as most people know that have been with us for a while, but just as a refresher for everyone else, we have two lists on the Leaderboard product, two main lists, and that's the leaders list and the cut list. So, of course, most of our focus is going to be on the leaders list. So when you pull up Leaderboard, the first thing you'll see on the front page there is the leaders list. And we start with a summary. Now, right now, there's about, 14 names on the list, something like that? So we're going to start with a summary on what happened in the market today. And this summary actually will happen twice a day. So you'll get one kind of midday, and then you'll see one at the end of the day to let you know what happened. So, for instance, today one of our Leaderboard stocks, New Skin, had a 6% move, and so that's what's showing up on the summary for this particular slide. Now, if you scroll down, you will see the names on the list. So we're going to start with the leaders near a buy point, and these are the ones that are going to be the most actionable the soonest. So if you think about it, for those of you that have been with IBD for a while, you know the way that we do our investing, you know the way that we look at our technical action, and you know how important it is for us to be buying stocks at or near their buy point, as close to that buy point as possible. So these are stocks that are near a buy point. They might be a little bit below it, they might be a little bit above it, usually within 5%, but they are within that window. So these are the ones you really need to be watching very closely.
Yeah, and just because a stock goes on the leaders list doesn't mean you immediately buy it. You want to wait until it moves past a proper buy point in volume and then go after it.
Right. So some of these stocks, they might appear on the leaders list and they never cross their buy point. And so, of course, you're never going to buy those particular stocks. That's why this is a watch list, an idea list, but you have to do your own due diligence and make those decisions yourself. Now, you're going to see charts for each one of the stocks that we have on our leaders list, and to the right, you'll see a summary for that particular company. And that summary is going to give you some of the technical action that's going on with that particular stock. A lot of times it'll say this is where the buy point was, this is how far extended you are, or how close it is to reaching a buy point. If it's coming back to the 50. Sometimes there will be some portfolio management rules that will alert you to in there. And then if you scroll down to the bottom of that summary, it will give you the backstory, which gives you some very important fundamental information. So you got an idea of what it is this company does and whether or not it's worth your money.
Right. What's driving the stock?
Exactly. And this is, keep in mind where this list is coming from. It's coming from a lot of the IBD screens. And how many guys do you have on the markets desk that are?
We're probably around 8 or 9 right now.
8 or 9.
And, so we're looking at the IBD 50, sector leaders, the weekly review. We're running our own screens. Stock Spotlight is another place that we pay close attention to. So we're always checking for new names, especially among the IPOs.
And then not only do you check for those names, but then you put it through a rigorous, 40-point, 50-point checklist, something like that.
Exactly.
And you have the benefit of a number of these people talking back and forth to each other, helping each other out. Oh, did you think of this? Did you think of this? So it's really covering all the bases there. If you scroll down a little bit further, that's going to get you to the regular leaders list, those that aren't necessarily near a buy point. So these might be stocks that are currently basing, or they might be stocks that are extended right now. So these are ones that you aren't necessarily going to take action on anytime soon, but you want to keep your eye on these. These definitely deserve to be on your watch list. So just because they're not actionable right now doesn't mean you want to just forget about them entirely. These are stocks that could just be finishing their base, and then, of course, as they get closer to their buy points, you're going to see them get on the upper part of the list there. Now, when you click on any of these charts, you're going to get a larger chart that gives you all of the annotations. So before we get to the annotations, let's talk a little bit about the left side of the screen, where you're going to get the IBD stock checklist. And this IBD stock checklist goes through those factors that we found in most of the best performing stocks going back through history. And we've got about 100 years of history at this point. So you're going to see very simple green lights, yellow lights, and red lights telling you how this particular stock performed in meeting those criteria. Green lights, of course, mean that it met the criteria. Yellow, it was close or didn't quite get there. And red lights were ones where it didn't meet the criteria. Now, a red light doesn't necessarily mean this is something that you got to throw out. For instance, sometimes you'll have a larger cap company that maybe has a red light in its sales growth because as a larger company, it's a little bit slower growing in its revenue. So, and maybe it's making up for it in stellar earnings. So you need to take, all of the green lights and red lights into consideration. And usually, if there's something that's a little funny, this is where that summary will come in again, because a lot of times that will be written about in the summary. Now, flipping over to the chart, you're going to notice that it's color-coded. The blue stands for those buy signals, and the red stands for the sell signals. And we're very simply going to be doing annotations for you and reminding you of rules and alerting you to things that maybe you forgot or didn't notice. And again, these markets desk folks that are doing these annotations, they've been with the company for a while. These are not newbies, fresh off the bench here. These are people that have been with us for a long time. They've gone to numerous seminars. They've actually participated in a lot of studies themselves, so they really know what they're talking about. They're going to be doing these annotations for you, and you'll also see that some of these notes are going to be in black. Those are more informational, telling you about extra technical action that is noteworthy.
Right, key technical action.
Mm-hmm. So in this case, we're looking at New Skin Enterprises, and you can see where the original buy point was on this particular stock. We alert you in black to what the buy range was because we like to buy things within a 5% window. And then this is a particular stock that was up 20% from the buy point in less than 3 weeks, and we're letting you know about a particular rule that it triggered, a hold rule in this case. So we're letting you know about some portfolio management stuff too. And we'll talk a little bit more about those portfolio management issues. Now, if you flip over to the cut list, this is our other main list that we have on Leaderboard. And these are stocks that there's two ways that the stocks can get on the cut list. Either it was a former leader that flashed sell signals. And so the sell signals were bad enough that we put it onto the cut list. Now, we put it onto the cut list because we don't want to, again, let this stock completely drop from our radar. We want to keep track of it. And sometimes you will see these stocks go right back onto the leader list if they're able to show strength. But for now, these are stocks that were former leaders and are now on the cut list because they flashed sell signals. The other way a stock will get onto the cut list is if it's flashing some potential short sale characteristics. So those candidates that have maybe they've come back to the 50-day number of times and it's getting resistance at that line, we might alert you to that because that might be a short sell possibility. Now, we're also going to warn you of what's going on in the market.
Mm-hmm.
You have to remember the importance of the market, whether you're going on the long side or the short side, and that's why on each page you see that big market in confirmed uptrend, the big green arrow, letting you know what's going on with the market. So don't lose sight of that.
And in most cases, those cut list candidates, they will have been big former leaders that they're now past their prime and they're starting to roll over.
Yeah, and a lot of times these are stocks that have actually, it's about 5 months since they topped.
Mm-hmm.
So we're not trying to get these stocks right at the top. We want to get a less risky when it's they've already broken down. We're not trying to time the top here by any stretch with the short selling. So if we go to look at one of our cut list names, SolarWinds was a stock. This was actually one of the first stocks that we had on Leaderboard when the product was initially launched, and it was at this original double bottom. And so it came out of this double bottom in 2011, and it had a nice move. Now, there were a couple fits and starts where it would break out, it would make a little bit of a move, and then it would base again. And so this is where sometimes you have to realize that something might stay on our list, but there might be a number of different ways to handle it. So we'll talk a little bit more about that later on. But just realize that we're going to keep these names on the list for as long as they're acting appropriately. Mm-hmm. And so if you've got a good cushion on a stock, that's going to really change the way that you handle it. When you get a big cushion on a stock, you can sit through a minor correction a little bit easier. So in this case, SolarWinds went up considerably. There were a few times where it did go onto the cut list, and you see that in red because that was negative action, a sell signal that was flashing there, and then it went back onto the leaders list. Now, eventually, this stock ended up topping and started rolling over. It got beneath its 200-day moving average. It got beneath its 50-day moving average. And now it's finding resistance at that 50-day moving average, or the 10-week if you're looking at the weekly chart. And so we have it here as a short sale candidate. This is not something that has been on the leaders list for a while, but now it's on the cut list because it's a potential short sale. Again, you're going to want to keep in mind what's going on with the market, but that's how to use the cut list.
Right, and about 4 weeks ago, you see how it bumped up against the red 10-week line, and then when it reversed through there, we put the flag on that this is a potential short sale, and it's down about 13, 14% since then. So it's getting to the point where if you did short it there, you probably want to be looking to lock in some profits.
And a lot of times that will be also on the annotations.
Yes.
We'll let you know where those profit-taking chances and opportunities are as well.
Yeah, so, generally we're looking for a 20% profit on a short.
Which also kind of works on the plus side too, the long side too. So that's kind of how a leader played out from beginning to end. Why don't you talk a little bit more about that life cycle of a leader?
Well, every top stock goes through similar phases as they break out and make substantial gains. And knowing where you are in a stock's life cycle as well as the market cycle is key to how you handle an investment. Now, a stock breaking out of a first stage base is completely different than one coming out of a late stage base. And again, how much profit cushion you have governs your reaction to a stock pulling back or breaking under a moving average line. But all those things work into how you handle a stock. So, two people with different profit cushions will handle a stock completely differently. So let's take a look at LinkedIn. And we talk a lot about base stages, especially on the weekly charts. And the reason for that is we like to invest in stocks that are coming out of first or second stage bases. And in the case of LinkedIn, it was an IPO. It had a big loose base that you see that we annotated down there. And then it turned into a tight base. And we actually had it on the leaders list last August, and it broke out. But what was happening last August? Well, the market went into a correction, and most stocks followed the direction of the market. So now LinkedIn started building a new base. Now, this base was actually even tighter than the previous base, and especially you see that in the handle area. And we put it back on the leaders list on December 31st, just as the fiscal cliff was being resolved. And then a week or two later, in early January, this thing broke out and started running. And then when it reported earnings, you see that big spike up in blue next to the December 31st annotation. That was the week it reported earnings. And so now this thing is really acting strong. It's essentially, triggered the 8-week hold rule. This is something that we want to try to hold on to and go for a bigger gain. And it runs up. It starts correcting again. We kept it on the leaders list the whole time because throughout that base that had the 203.01 buy point, there were no sell signals during that base, and so we kept it on the leaders list. And now it's breaking out of essentially a third stage base. And now we're getting a little later in the cycle, and it breaks out and also gives you a little short stroke buying area, and now it starts getting into trouble. So it breaks under the 10-week moving average on October 8th, but it comes right back the following week, so we put it back on the leaders list. And then just a couple weeks ago, it broke again in big volume, and now it's been on the cut list ever since. Maybe it's making a double bottom base. We'll see how it shakes out. But let's go to the daily chart to get some more detail, and let's zoom in a little bit. And then this was this prior base around 203. And you see it broke out and pulled back a little bit and then gapped up probably on earnings there. And you'll see how we always will put the 20% price target on a stock that's breaking out of a base. And the reason for that, that's really essential in managing your portfolio properly. If you're taking many 20, 25% gains on the way up and then really focusing on just a few stocks to go for big winners, you'll really be in sync with the market. You'll find that you're feeling better about yourself because you're actually booking some profits. And the interesting thing is that let's say you take a couple of those intermediate term profits, and all of a sudden the market starts acting poorly and starts pulling back. Well, you've already raised cash in your portfolio because there haven't been new stocks to buy at that point. And so you're really a step ahead of the game. And it gives you the wherewithal to clearly focus on your portfolio and say, okay, I've got these two stocks that look like really big winners. I'm going to sit through this market correction and try to go for a really big gain. But you really can only do that if you're taking these profits along the way, because otherwise what happens, the market gets into trouble, and let's say you've got 8 stocks and they're all down 3, 4, maybe some are down 5% on a day. How does that feel?
That's where you start to feel really not good about yourself.
Right. And you'll start to make, snap decisions, and you won't look at things individually. You'll say, get me out, and you'll sell, stocks in mass.
A lot more emotional when you're looking at a sea of red.
Right.
Now, another point about that 20% rule is what happens with a lot of these big leaders that have these moves is a lot of times they go up 20% and then they base.
Yeah. We see it over and over. A stock goes up 20, 25, maybe 30%, and then it builds another base for maybe 7, 10, maybe 13 weeks. And so instead of sitting through a correction like that with dead money, you can be taking that money, finding another stock, and you get this continual compounding effect. And that's how you can really end up having a great year without having to sit through a lot of corrections. Now you'll see there's a red flag there at the top. It says achieves 20% gain from 203.01 entry. So that's a time that you could be taking that 20% gain, especially if you bought LinkedIn for the first time at that base. So you've only got a 20% cushion. Now, if you had bought in early January, you're sitting on a 100% cushion. So you don't necessarily need to take a profit at that point. Maybe you decide that you want to continue and try for bigger gains, or maybe you sell a little bit. You also see that flag as it breaks through the green line, and the green line is the 10-day moving average. And one of the things that we like to do on Leaderboard is stretch out those 20% gains. So once they hit the 20% mark, we'll let them run until they break the 10-day for the first time after achieving a 20% gain. And sometimes we can stretch a 20% gain out to 25, 30, even 35%. So we've done that a number of times. In this case, 2 days later, it breaks down and it goes underneath the 10-day line, and at that point you're probably looking more like a 15% gain, which is still not bad. It's not a 20% gain, but at least you're not going all the way back to your old buy point. We call that a round trip, and that usually feels pretty bad when you've been sitting on a good gain and now it's all gone.
All that work for nothing.
Exactly. It only has to happen a few times, and then you get really wise to it. So, after that point, the stock did recover a little bit and made a new high, and then started building another base and broke through the 50-day, and volume came back up, and it looked like it was making a cup with handle, and you see how we have that outline there, and we have the buy point at 253.76, and this is a good example of, let's say you just started taking Leaderboard while LinkedIn was making that base, and if you jumped into it before it broke out, well, it never did break out, and then it started selling off. So there's two things to look at here. One, the stock did not really make any more significant gains past that 20% profit flag that we showed you. And if you jumped in ahead of time, now you're looking at a loss, and you need to cut that loss and get out.
Yeah, it usually doesn't pay to try and get in super early to try and get an extra couple points. It's much better to wait for the proper buy point, some logical point of resistance. That way the odds are just much more in your favor.
Well, that brings us to our next topic, and that is cutting losses. And cutting losses, we say it all the time at IBD, it's the number one rule in investing. If you don't cut your losses short, eventually at some point you're going to get whacked by a big loser, and it's going to take a lot more gains to make up those losses. So let's look at a recent example of how this rule really was important in practice with a stock that was on Leaderboard, NQ Mobile. And before we go into some of the details of the trade itself, let me just address some of the issues surrounding the stock. And we've had lots of questions from people asking, why didn't we know that the stock was potentially fraudulent and that short sellers were after it. The first thing to know is that every major growth stock has a committed group of short sellers gunning for it, whether they're on the message boards or, dropping rumors to reporters. I get calls all the time from people trying to, plant stories about stocks.
It's in the best interest of the short sellers, right, for that stock to get down.
Yeah. Now we have Seeking Alpha. It's a much easier way for people to post stories. Or you have short sellers who've got their own newsletters like Citron or Muddy Waters in the case of NQ. So the fact that there are short sellers making claims about a stock, sometimes saying that there's fraud going on, is really not unique to the growth area. In fact, there's a couple other big stocks right now that have the same sort of shorts going after them. One is Qihu 360. The ticker symbol is QIHU. This is a stock. We didn't actually put it on Leaderboard because there were some issues with the earnings. They were, I think, negative or only at 10% around the time it was breaking out. We had looked at it earlier, but when we were looking at it earlier, we noted that there was a short seller that was claiming that their business model didn't make sense and that all the numbers that they claimed were far outside of anyone else in their competitive space. And Qihu has gone up, 400%, I think, this year. So just because you've got short sellers going after a stock does not mean that there's necessarily something nefarious going on. Now, a stock that's on Leaderboard that's also been the target of short sellers is Nu Skin. And Citron has been going after this stock for more than a year. And in fact, I think just a couple of weeks ago, they issued an updated report, and the stock sold off in the morning and then came back. And today it was making a new high in volume. And there's a lot of big investors in that stock, a lot of volume. There's always people taking shots at growth stocks, and it's just part of the landscape.
Yeah, every stock is risky. I mean, that kind of comes with it.
Right. Well, let me just say with NQ, for example, I checked on this. At the end of the third quarter, there were 61 mutual funds invested in NQ, 83 investment advisors, 25 hedge funds. And the stock traded 2 million shares a day. So this was not individual investors and pump and dumpers in the stock. These are institutional investors with names like Fidelity, T. Rowe, Goldman Sachs. They were all investors. They have teams of analysts. So again, it's not like if this turns out to be truly a fraud, they fooled a lot of people in the business, and the top people as well.
And that's still in question. There really hasn't been much to substantiate this claim yet.
That's correct.
We'll talk a little bit about the technical action that happened here with NQ.
Well, let's look at it. So the stock had run up from 10 to 20 very quickly. It's what we call a flag, and then it pulled back in a fairly restrained area. So that's your flagpole, then your flag. And as it was coming out of that area right around 20, we had it on the leaders list, and it broke out in big volume. And you can see it went up to 24, so this thing is up 20% in just a few days. It's triggered the 8-week hold rule at this point, and there is one override to the 8-week hold rule, and that is when a stock round trips. Now, you never want to let a good gain of 10% or more, and certainly not 20%, turn negative on you. So if it is going back toward the old buy point, you want to be selling, if not at that buy point, maybe even a little bit before. It always makes you feel a little bit better if you walk away with a small profit.
And there's two reasons for that. Number one, it's demoralizing.
Sure. Right.
But number two, it's not normal. That's
right.
Not what normal leaders do.
Exactly. A lot of leaders, they might go up 5% and then pull back. But if you're 10, 12, 20% above the buy point and coming back to it, that's not quite normal. At least you know you have a very volatile stock. So at that point, it returns to its buy point, it sells off even more the next day, reverses, and then starts going back to the buy point. And you see that support flag right there. So let's go to an intraday chart of NQ at that point. And so you see there on the left, it breaks the $20 level, and this is a 30-minute intraday chart, so it covers a number of days. So it breaks out at 20, it goes almost all the way to 26, and now it's up 30%. It starts pulling back a little bit. The first part of the pullback looks very normal, and then on that day, I think it's the 24th or so, or 25th, it starts selling off really hard once the Muddy Waters report comes out. So at this point, you've got sell rules that you know. One, you shouldn't let a stock make a round trip on you, so you should be selling at 20. And if you don't, if you miss it there, well, now when it gets to about 1840 or so, it's down 8% from your buy point. So you should never take more than an 8% loss. So that's another place where you can sell the stock and get out of it.
And now, that would have been the second time that it had the big gain
right.
and came back to the round trip.
Right. So the thing is, whether it's a mental stop or an actual stop loss order, you need to have that and be ready. So it's one thing to have a stop loss, at least in your mind, but then you need to act on it. And so if you're watching a stock throughout the day and have that ability to monitor your positions and you see it pull back, then you immediately sell. No questions asked. That's just not normal action. And if you're like a lot of us, even people here who work at IBD, we don't sit in front of our computers all day. We've got lots of things to do. We use stop-loss orders or variations on those. But the idea is the same, is that you put in an order ahead of time that says if this stock sells, hits a certain level, in this case 20, or if you didn't update it and you're still around 1840, then your brokerage automatically submits a market order, and you get that stock sold and out of your portfolio.
And that could be a stop limit or a stop market. We generally want to do stop market, and the reason being that we don't want to quibble over a couple points when that thing is getting down that much. We just, put in a market order if it hits that trigger. Now, if anyone's read the book, How to Make Money in Stocks, you know that William O'Neill is not a big fan of putting in the stop-loss orders with a specialist because he doesn't want to show his hand. I use stop-losses myself because I travel, and I just make it a part of my buying because I never want to be on a plane and realize, oh my gosh, that flight just cost me a lot of money. And I don't generally worry about the specialist coming after my shares like Bill might. But now they have a lot of other options too, where some brokerages have it where instead of going on the specialist books, the broker will handle it for you, and it doesn't go to the specialist until that trade trigger or condition happens. They're called
right.
Conditional orders.
Conditional orders, and they're very useful. So if you're not able to watch your stock, or even if you are the person who can watch your stock and then you freeze up when it's time to sell, we would highly recommend that you use stop-loss orders or some sort of automatic protection, because NQ is a perfect example of what can happen if you're not on top of it. And now an 8% loss turns into, it could be a 50% loss or 40% loss. And we definitely we want to avoid those whenever possible.
forced discipline is kind of what you can think of it as.
Absolutely right.
So let's talk a little bit about leaders that are setting up right now that are near a buy point, because this is the most exciting part of the list, right?
Exactly. We're all always interested in what's getting ready to move, what may be moving right now. So let's take a look at a couple.
And it should also be noted, this is why sometimes when a market is going through a correction, there's actually a little bit of excitement around the office.
Oh, yeah, absolutely.
That's when things set up.
Right. That's I can't stress this enough. You always need to stay engaged with the market, and the time that you probably have the least interest in the market during a correction is when you should have the most interest in the market, because that's when the new crop of leaders are setting up and the possibilities are just out there, and we're all just waiting for the follow-through day and then to jump in when these stocks start breaking out. And, when you get a good follow-through like that, you can tell if the market really has some power behind it, because big stocks with great earnings start breaking out immediately.
And if you wait for the TV to tell you when everything is looking rosy, that's usually a little bit late.
A little bit late. So this is Alexion Pharmaceuticals, and it had a big move and then took the last year off. It undercut a prior base back there at the beginning of the prior year, and so it's just been going sideways and consolidating. And let's zoom in on it a little bit. And so it popped up and then made a first stage double bottom base. So we love first stage bases. It's reset, so it's starting over. The buy point is just over 118, and it really ran through that on around its earnings report.
So now a couple of people might not realize what we mean by reset. They're looking at this was a first stage base way back at the beginning, and it went up all that way. How are we saying that it's breaking out from a first stage base, right about now?
Well, it runs up, and then you can see. Actually, go back a slide, and you'll see before it really started going sideways, it undercut one of the previous bases, and when a stock undercuts a previous base, that resets the whole base count. And so now this consolidation that has been happening for the last year is now a first stage consolidation. The stock made a base within that base, that double bottom base, and so that remains first stage. And so that's why we were very focused on it and interested in it.
Because the odds just go up. When you get closer to those first stage bases, the odds are better. As you get into the third and fourth, they go down pretty dramatically.
The odds are always better when you're early in a market run. As you get further in a market run, now it gets a little dicier. But again, if you've got a first stage base, I like those a lot better than fourth, fifth, and sixth stage bases. So let's take a look. Let's zoom in on that daily chart where the stock is right now. And it had 3 really big up days on heavy volume. Zoom right through that 118.39 buy point, and then the market got a little sloppy, and the stock pulled back. And you see it came right to that red line, and that red line is the 50-day moving average. It got support, and then last week it came through the buy point again. So if you had missed it the first time, now you can buy it on the second rebound, and it's still within buying range. It's acting pretty well. I think that this stock is really, whether it succeeds or fails, is a function of the market. The earnings are great. It's got one main drug that is they're expanding to overseas markets. There's new indications for it, and then they have more drugs in the pipeline. So a lot of good things are going on at this company, and they have a history that when they have a good drug, they know how to sell it, and they know how to make big money.
Make quite a bit of money on it.
Yeah,
they're the orphan drug firm,
right.
The ones that the big pharma doesn't want to play with. Now,
right.
Another kind of interesting thing here, you were talking about how this pulled back and went, back to the 50-day line, the red line there, and it's interesting because there's a note at the bottom. It's talking about how there's support, but because it occurs below the buy point, you said that this might be a place where you could pick up shares, but it wouldn't be a place where you would add shares.
Yeah.
Because we don't add to something that that we're down on.
Right.
We don't average down.
Exactly.
So again, we're going to give you some helpful portfolio management tips along the way with the technical action.
Next stock we want to talk about is Las Vegas Sands, and it's a big casino stock. And even though Las Vegas is in its name, and there's definitely they have properties in Las Vegas, most of their money is now coming from Macau and China, and a lot of growth in that one region where gambling is allowed in China.
You know what? I was reading that there's two of their properties have more of an effect on their earnings than all of the Las Vegas properties. It's like all of Las Vegas comes in third.
So it's really a China play. It's a turnaround. They're seeing earnings reaccelerate, and we put it on the leaderboard back on August 26th. And then there was a little weakness in the market. It broke through the 50-day line one day and then came back a few days later. And so I think on September 3rd or something like that, we put it back on the cut list. So that's another example of how a stock might go back and forth. And then it broke out, and it's run up 20% since then, and now it's getting support at the 10-week. And let's look at the daily to get a little more detail of what's really going on in this. So the stock broke out around 58, and you see the buy range up to 61. So that's where you could, if you missed it the first day or the second day, you could still be buying it. And then it gets up to 58.21. Is that? Oh, I'm sorry.
Yeah. So it was getting up to 69.85 from the 58.21 buy point.
Okay. Now I get it. All right. So at this point, if you had purchased it there, you could be selling and taking your 20% gain. Maybe this is a first stage base, so it wouldn't be imprudent to be holding it for a longer gain. But the good thing, look at the thing that's going on right now. It's been about 6 weeks since it hit that 20% profit threshold, and it's actually still consolidating and a little bit below that level, although it is getting support at the 50-day and the 10-week moving averages. So this is a stock that could be played a number of ways, depending on your conviction and your outlook. You could take that 20% gain, wait for it to set up again, see how the market's acting, and then get back into it. Or maybe you sit through it all, and now you're adding 10% of your position and trying to build up your position. So far it hasn't been a screamer. It's doing well, and it was up nicely today, but I don't think the volume was exceptionally strong. But the volume wasn't really that strong across the market as well.
And here is another case where you see right in the middle of that move, there was another buy point at 67.45. And so someone that may have been putting this on their list, and maybe they didn't buy it at the earlier buy point, and they bought it at the later one, they might handle this a little bit differently.
It'd be much quicker to take a profit.
Absolutely, because you don't have that cushion.
Right.
It makes a big difference. What else do we have?
Well, the last stock we want to take a look at is Precision Cast Parts. And so they make a lot of aircraft engine parts, and Boeing had a great report out earlier in the week. So this is all part of the aerospace industry that, as a industry, this has been doing very well lately. And I think it's coming out of a second stage base. Now, what was kind of held us back from putting it on the list earlier was that there just wasn't any volume as it kind of limped through that buy point. And so then the earnings came out, and you see that big blue spike there near the top, and it's been pulling back very quietly since then, and actually formed a 3-week tight, and now we're getting some volume back on the upside. So we put it on Leaderboard. It's still pretty close to that original buy point coming out of the 3-week tight. Let's take a look at the daily and zoom in on that. And so now that buy point is right around 263, and actually it looks like if this consolidation holds up, maybe we might move the buy point a little bit lower, because there seems to be more recent resistance right around 260. So that might be something that you'll see change over the next few days.
Now, you mentioned with Precision Cast Parts how this was something you were holding off a little bit on putting on the list. And we actually got a question that was asking about why some names didn't make the list, like Jazz Pharmaceuticals, some of those other names that are appearing maybe on the IBD 50, or other screens, but they don't make it onto the leaderboard list. Can you talk a little bit about why that might occur?
Sure. Well, we're looking at all the factors that go into canceling stock, and sometimes, for example, a stock might, the current numbers look okay, but the next quarter estimate is very weak. Or maybe the base doesn't look right. The numbers are good, but maybe it's a late-stage base. So there's all sorts of things that go into our estimation. And as far as Jazz, I'm not sure what the reason was. I know that we've looked at it before. I think we even had it on the leaders list at one point. But nearly all these stocks, they come up in our weekly meetings, and we talk about the market every day and the different stocks. So we really do analyze a lot of these. Sometimes, we're going to miss a few. Maybe we're going to put some on that don't, perform in the way that we think they will. But overall, if you stick to what we know really works, and that is if you combine really strong fundamentals with great technicals and you're looking at early stage bases, the odds are in your favor that you're going to do pretty well, especially in an uptrending market. And that doesn't mean you're going to get every single big winner. Maybe a lot of times there's hot money stocks where the earnings really aren't there, but there's a good story, and so people are chasing them and running them up. And we see that a little more often where stocks run up ahead of their earnings. But what we saw in the case of Facebook, for example, when it came public,
right,
the earnings did not look that good. During their registration period, earnings and sales slowed down, and it just was an unimpressive stock at that time. And so then it starts to consolidate, and then it surprised everyone with that big earnings report a couple months ago, and it just shot out of the bottom of the base. And so then we were looking for an entry point. We found one, we put it on there, and the stock is up, 30, 40, 50% since then. But we're not going to get everyone. We hope we're going to get most of them. We hope we're going to get most of the big winners. But the idea is we're always looking, we're always analyzing, and we're applying the canceling principles as best we can given the market conditions.
And like with Facebook, that was an example of where we insisted on, better earnings, and by waiting for those better earnings, we actually saved almost a year of sitting in a stock with dead money, because it took it that long to get back to its IPO price.
It would have been more than dead money.
Yes. 6 feet under, literally. Okay, so let's talk a little bit about the current market.
Okay. Well, the thing that I really want to first talk about is the overall environment for growth stocks. And the way that I judge that, and I do this all the time, I look at the IBD 50 chart, and the ticker symbol for that is 0IBD5. And you can call it up on your leaderboard charts anytime, the daily and the weekly. And the thing that I really look at, not so much the price bars, it's good to see what's happening there, but it's really the relative strength line, and that's that blue line there at the bottom, near the bottom of the price chart. And what that's telling you is how the stock is, the index is performing versus the S&P 500. So when the line is going sideways, it's just keeping up with the market. When it's trending higher, it's outperforming the market, and when it's moving lower, it's underperforming the market. So in the first part of the year, when the market was in an uptrend, and this is a time when growth stocks should be leading, that's why we call them leaders, that's why we call it leaderboard. But overall, growth stocks were just keeping up with the S&P, and that's a really unusual situation for an uptrending market. Normally, that line should be rising, and growth stocks should be far outperforming the S&P. Usually, by 50%. We like to double it.
And even the NASDAQ composite was underperforming the S&P 500 earlier this year.
Yeah, well, that was mainly because Apple had dropped and is rolling over. But the rest of the market, Apple was not in the IBD 50 at this point, and so it shouldn't have been affecting it. And so just in general, growth stocks were not leading the market. So they picked up a little bit, and then we got that correction during May and June. And again, now the line is going sideways, but that's actually a good thing, because when the market is going down, when we're in a correction, the S&P is declining, typically growth stocks are going to fall 2 to almost 3 times as much as the S&P. So the S&P falls 10%. It's totally normal for growth stocks to be falling 20, 25, even 30% in a correction like that. But in this case, the IBD 50 was holding pace with the S&P sell-off. It was going sideways. And a couple times we've even seen a nice divergence where the 50 has been rising when the S&P has been correcting. And the last time I remember that really happening was in 2010, and when the market followed through on September 1st. I mean, breakouts were just exploding everywhere, and that was a big move in the market, very profitable. So we always like to see the market outperforming in a correction. Typically, it underperforms, and that's normal.
And so in this case, the IBD 50 was going down, but it was going down just about as much as the S&P 500. So
exactly.
It was really resisting the downward pressure that it normally
and that's a good sign of strength. So then when the market followed through on July 8th, the IBD 50's relative strength line was making a new high when the market followed through. So that's very bullish. And then over the next 3 months, we see that line rising while the market was advancing during July, August, and September. And again, that's a very normal, that's the normal state of affairs. That's the way we like to see the market act. And that's why I'm sure a lot of people were making a lot of good money in their accounts during those months, because growth in general was acting right, the market was rising, and then if you focus on really the very best stocks, you're going to do exceptionally well. Now things started looking not typical in October, and actually the first part was okay because the market sold off, growth stocks sold off harder. That's normal, but since that time we've got a divergence going. So the IBD 50 has recovered and made new highs, but it's actually lagging the S&P right now. And in fact, that RS line has a downward slope to it. So it's not just going sideways; it's actually moving lower. And so if you've found in October and November it's been kind of tough to make any headway, and sometimes the market's up and your portfolio's down, this is why. Growth has kind of fallen out of favor in the market right now, and I think it's really a function of quantitative easing. It's kind of turned the market upside down and shaken it a little bit, and it's nothing quite makes sense when the Fed is pumping $85 billion into the economy and the stock market each month.
Yeah. So now, where do we stand right now in the market then, in terms of the overall sense? I mean, you talk a little bit about how it feels heavy,
right.
That idea that, in that kind of environment, and I find this, at least for myself, when I'm not keeping pace with the index, it's like,
something's wrong.
What's wrong here?
Yeah, at the very least, you shouldn't be on margin right now. You might want to, raise some cash, but then you get a day like today where everything looks normal again, and maybe that's now it's going to shake it all off. I don't know. But, the fact of the matter is we're looking now at the ETF market strategy chart, and this is of the NASDAQ. And if we won't go into the strategy tonight, if you want to learn more about it, go to the About Leaderboard tag on the front page of Leaderboard, and there's a video that explains the strategy. But the important thing is you see those D's and S's up there, and those are distribution days. And a distribution day is when the index falls in heavier volume than the day before, and a selling day is when it can't make any headway and volume usually increases from the day before, and that's also a form of institutional selling. So we've got 6 days of selling on the NASDAQ. It started to correct and then rebounded and pulled back 3 days this week, and today had a nice rebound. Volume it turned out to be a little bit lower on the NASDAQ and higher on the S&P. So again, we would prefer to see the market rise in heavier volume and pull back in lighter volume. It doesn't always work that way. But overall, we've had a lot of distribution in the market this year, and I think, again, going back to QE, without QE, when the market, gets 5, 6, 7 distribution days, it usually means there's at least an intermediate correction in the offing, and that's what happened in 2012. We had a follow-through signaling that the market was shooting higher, and then we rallied for 4.5 months. Distribution started piling up, and so the market went into a correction. We had changed our outlook at that time. Had about a 12, 13, 14% correction in the NASDAQ, and then there were a couple false starts, but we had another little run going into August and September, then another correction, and then the market followed through right at the end of the year. So this has been an unusual year in that we get a lot of distribution, the market starts looking weak, it sells off, and then just when you think it's really going to collapse, it just kind of shakes itself off and starts moving higher. So at some point, it'll start acting more normal, but at this point, we're near highs. We got a lot of distribution. Feels like some days it bothers me when leaders don't keep up with the broad market. That's never a good sign. But overall, we've been in a bull market this whole year.
And again, this chart that's marked up is something that is available to all Leaderboard subscribers with your Leaderboard subscription. So let's talk a little bit about how the Leaderboard has performed this year.
Well, when you put together what we've been talking about looking for stocks that show all the CAN-SLIM attributes, strong sales and good earnings and strong price action, and then you're keyed in with the market, we're able to get results like these where we're up 54.8% year to date, and that's more than double the S&P 500. And that's pretty normal for an uptrending market, and that's what we like to see. When the market's in an uptrend, we want to at least be doubling that performance, and especially when we get into a really strong bull market, you can even see a triple or even more.
And it should be noted that this is taking the Leaderboard names as soon as they get on the Leaderboard and keeps track of them until they come off.
Right. So a lot of times, I think that it understates the true performance, because if you're buying on a breakout and not just buying when a stock goes on the leaders list, and then taking a lot of stocks taking profits on the way up rather than waiting for a late sell signal, which is when we typically take it off the leaders list because we try to give it some room and go for that longer gain. But again, the way that you trade it, can have a huge effect on your performance. And I think that taking a lot of those 20% gains on the way up can make a big difference.
Mm-hmm. So let's go ahead and move on to Q&A. And so I'm taking some of these questions that have come in as we've been speaking. And someone asked, do you sell every time a leader moves to the cut list?
Well, it depends on the stock. And again, it depends on what my cushion is. Mm-hmm. I'm probably quicker to sell in most cases. And so when I'm being very disciplined and on top of my game, I like taking those 20% profits. Or at least, I pay a lot of attention to the market. And even when the market shows a couple distribution days, I might be lightening my portfolio at that point. So there's a lot, sometimes, my sales will correspond with a stock moving to the cut list, but not necessarily. If I'm doing it right, I should probably be out before it's that obvious.
Yeah, I definitely, if I have a stock and it goes to the cut list, I'm like, well, I'm looking really serious.
At that point. But by the same token, if you're in LinkedIn, for example, we've talked a lot about that stock tonight, but it's a good example. And you bought it early on, and you maybe added here and there, and so you've got a good, you're up more than 100%, and you've got a lot of conviction about the stock. It doesn't look great in this space, but that's not to say that it can't pull out of it and start running again. I mean, Celgene had an E accumulation distribution rating a couple days ago, and now it's back near new highs. And, if you've got conviction about a stock, you've got a profit cushion, the market's in an uptrend, you can sit through even a trip to the cut list.
Mm-hmm. Now, we've talked a lot about 20% gains, mm-hmm. and so we got a question saying, do you sell your entire position after the 20% gain? Do you cut half? Now, we talked a little bit about that 10-day as an option for letting it play out a little bit longer. But do you usually sell a portion, or how do you handle that?
I think. I guess it depends on where I am in the market and how things have been going for the year and things like that. I mean, if I don't have a lot of conviction about the market, and I have to say personally, I have not had a lot of conviction about this market this whole year. It hasn't acted normally nearly the whole time. It was very normal during the summer, and I loved it, and that was a much more bullish time. But when the market's not acting the way it should be, maybe I'm probably much more likely to sell that whole position at 20%. I do like to let it run and see if I can stretch the gain with the 10-day rule. But it just, again, as with most sell rules, it depends. It depends on what's happening in the general market, how your overall performance is, how much conviction you have about a stock. I guess the main thing is if you cut your losses quickly and you take a fair number of intermediate profits and try to go for a few big gains, I think you're going to do pretty well in the market.
So now we got a question. Someone was asking about the stop losses, and they said that they've been pretty diligent about setting up their stop losses, but they keep on getting hammered when the company releases earnings after the close and the stock dives. How do you handle those types of situations? So,
you mean an after-hours trading?
After hours, right? Yeah.
Well, I think that in some platforms you can say whether or not you want the stock to be sold after hours or only during exchange hours, normal trading hours. And so I would try to avoid reacting to after-hours action. I mean, we've seen stocks that look great after hours and then they plunge the next day and vice versa. So that would be one thing. And the other thing, too, we'd have to know what some of the names are. Most of the names lately have been acting pretty well on earnings and have been, we've seen it. They're gapping up and running higher. We have had a couple of miscues here and there, but overall, if you're seeing that a lot in around earnings, I guess there's a couple things. Maybe look at the stocks that you're buying,
the quality of the stocks,
the quality of the stocks, and if it's really something that you're having trouble with, wait until the earnings come out. And it's always, actually, if the stock ends up gapping higher, buy it at the open, because buying on a gap out of a base on earnings can be a very bullish time to buy. And it cuts down your risk. And you feel stupid for missing that first 5, 6, or maybe even 10%. But we, in our model books and in our presentations, we have so many examples of stocks gapping out of bases on earnings, and game on. They're off to the races.
And I mean, personally, a lot of times, if I don't have at least a little bit of a cushion going into an earnings report, it makes me feel a little funny. Now, sometimes it'll depend on the market, of course, because as most things do, sometimes you get into a market situation where it seems like it's an earnings season where it's just unforgiving. And if it misses slightly, if the CFO coughs on the conference call, it's going to get hammered, as opposed to others where you missed, but, it's okay. Or, so, I mean, sometimes that does have to do with the market as well. Are you worried about the stop-loss orders in a flash crash type situation where a stock can get filled at the bottom?
Well, we've had one flash crash in the last 3 years, so, I mean, it is a possibility. I guess I don't really wake up each day and say, oh, this could be the flash crash day. But if you really worry about that, then maybe you need to be the type of person who's watching your stocks throughout the day. And if you see the whole market selling off and you're feeling like, okay, this is a flash crash, not something real, maybe you sit through it. But I guess it's a rare enough event that it probably wouldn't have a big effect on your overall portfolio.
Yeah, it'd be hard to say change all the rules for that thing that's only happened once.
Right.
A couple extra, we're kind of running out of time here, but a couple extra things that people should just be aware of. that there were a lot of questions and emails that came in that we didn't get to answer, but we actually do have customer service agents that will be able to answer many of those. So, that's an option for people. If we don't get back to you, we should be getting back to you within the next couple days with some answers on those.
Sure, and always post your questions on the forums. We've got people looking at the Leaderboard forums every day, and I like to go on there and I'll answer questions as well. So it's a great way to engage with the writers and the editors on Leaderboard on a day-to-day schedule.
And actually, some of the subscribers are some pretty astute.
Yeah, well, that's absolutely true. There are a number of subscribers who really know what they're doing, and so I might be ready to answer a question, and then someone else jumps in and they've done it better than I could. So there's some really smart, great people on those forums. Well, I think we're out of time. I appreciate everyone tuning in with us tonight. And again, if you have any more questions, give a call to customer service, the concierge line. You always go to the front of the line if you're a Leaderboard customer. And the forums are great, and we're always happy to hear from you and listen to your suggestions. And sometimes there might even be a complaint or two, but we love listening to those as well. So again, thank you very much, and we'll do this again in a few months.
Sounds good.